Before getting started, I think that very shortly about Invesco Real Estate. We're a global asset manager with 40 billion euros of AUM. In Europe, this is 5 billion euros. We have offices in London, Munich, Paris, Madrid, Prague, and Stockholm. We have transacted for 2.5 billion euros last year, and we're aiming to close 1.5 this year, and target per year would be 1.5 billion for transactions volume. I am responsible for the European research for Invesco. I'm based in Paris with a particular focus on France and Spain. The way we do research at Invesco is providing every 6 months an update of our house view about prime property market outlook. We try to give best recommendation for investments and pan-European allocation. So let's start by the economic outlook. The clear message here is that what we expect is 2014 to be quite moderate in terms of GDP growth, and stronger GDP growth rates expected from 2015 onwards. But overall, what we can say is that for most European markets, what we expect from what we say about recovery trend rates is that it's well below the trend rate recorded in the past, in pink here, before the global financial crisis. Non-Eurozone economies will outperform, namely UK, Poland, and also Nordics. France, in particular, should see some very moderate 1.3 to 1.4% per annum growth from 2015 onwards. One of the key metrics we look at is the sovereign 10-year bond yield rate. We're currently in a very low environment. We saw last week the announcement from the Federal Reserve to maintain low longer, and this is also the case for Europe. For Europe, this is also due to very low growth prospects. So we're evolving in a low environment for bond yields, but also low growth prospects for most of the core European countries. Here you have France, here at 2.2%. Nevertheless, we expect in the next 5 years to see some gradual and slow, but still gradual upward trend for the bond yields. So in 5 years' time, we expect for France, for instance, to see bond yields at 4%. What it does mean is also when you're having a recovery in upward trend for bond yields, it's also due to stronger growth prospect considerations. So it's all good whenever we see, but it will be gradual and slow. So this is not a sharp increase. This is a progressive increase expected. In terms of property market, if we look at the liquidity in terms of investment for commercial real estate in Europe, what we can see for 2013 based on the first half of the year is that it's been increasing here for Europe as a whole. I've highlighted France, where there were some 7 billion euros invested in commercial real estate. We expect for 2013 to reach a total volume closer to 15 billion euros, which is slightly below the long-term trend level, but getting closer to it. And the drop, which was recorded in H1, was due to the fact that during 2012, there were very large deals bought by sovereign wealth funds at that time that contributed to the big activity at that time. One of the key improvements here is the liquidity improving in Southern Europe, in Italy, but also in Spain. We're seeing an increasing appetite for those countries. And we'll see later on that there are different timing, different cycles in terms of capital values across Europe. What's quite important to see is that since the crisis started, investors have tended to remain focused on core, prime, secured asset, long-let, brand new, and central locations. And actually, everybody wants the same. It has pushed prime yields down significantly since 2009 and 10. And we can explain it partly by the fact that the current bond yields, the 10-year sovereign bond yields locally in core Western European markets, they're low. And the weight of capital, for instance, in France, pending from domestic insurance companies, in particular looking for core assets, is still maintaining the current property yields at low levels. In red, I've highlighted the French property yield for prime. This is an average for all sector commercial property. we have a 6%, which compared to the 10-year bond yield of 2.2% provides still an attractive premium over the risk, what's considered as risk-free rate. I think that more interestingly, the capital value is the metric to look at consistently across Europe. This chart is quite heavy and difficult to read, but I think that what we tend to do is very often we compare the current values today achieved to the last previous cycle peak levels. What I prefer to do is looking at the long-term average calculation since 2001. And why since 2001? It's because this is the only period where I do have the most consistent and comparable series of data available across all sectors and across all European markets we cover. So basically, my benchmark here is using 100, which is the long-term average calculation. I compare, in terms of indices, what were the values at peak, at trough, in dark blue, and in pale blue, the current value. This gives you an indication of how far the correction was recorded in each market, but also since the trough estimated in each market, what was the repricing. So let's take just two basic examples for office market. Here, I take the core Eurozone, which includes the French market. I compare it to the Southern European markets, which include Spain. What I can see here is that actually at peak in 2007, where in Paris CBD, for instance, prime offices, yields went below 4%. Prime rents were at above 820 euros per square meter per annum. Because of the crisis, the correction achieved here in dark blue in Paris CBD, yields move out above 6%, rents fell by 12%. So the correction was recorded driving capital values down slightly below the long-term averages. But since then, in pale blue, what you can see is that yields have moved in quite significantly. We're talking about 4.5% below 5% for the very core good assets in the CBD, and rents are close to their pre-crisis levels. We can have an idea of the extension of the repricing since then. Now, if I compare it to the Southern European markets, what I can see is that the trough here is actually close to the current values, which suggests that maybe in this market we're close to the trough. So this gives an idea of where there might be opportunities to get the stronger than average potential value growth. The second chart is clearer, I hope. This gives an idea just to take the current values compared to the benchmark of 100, which is my basis, the long-term average. And clearly, what stands out is that all the markets in green here are those where effectively the potential of value growth would be the strongest. And of course, it would matter on the underlying assumptions and on the specific asset, but that gives us an idea of where we could find the best performing assets. Now in red, I've highlighted the markets in France. So Paris High Street, Paris offices, French regional offices, for instance, they've exceeded their long-term averages. They're still below their pre-crisis peak levels in 2007, but they've exceeded their long-term averages. Now, we've seen what's happened so far in the past. I think that maybe most interestingly, we'll see what would happen or could happen in the next 5 years. And by sector, I thought that rent growth projections would be the most interesting to see. For offices, we tend to take GDP growth for demand driver. We compare the supply, and we try to estimate what would be the rent growth projections over the next 5 years. So this is giving you an idea of the total accumulated rent growth projections for each market, prime property, across Europe. And in red are the markets in CBD, for instance. We're expecting average rent growth for prime offices slightly below 2% per annum over the next 5 years. 2014 should be no growth. The growth should start from 2015 onwards. This is supported by the tight level of vacancy and the stronger demand expected in the CBD. In contrast, we're expecting in La Défense slightly below 1.8% per annum on average over the next 5 years. This is also due to our concerns about the excessive supply of Vermont, which is being completed, will be next year, and to see how the market is going to absorb that excess of supply. For logistics, this is clearly a sector where structurally the rent growth prospect is the weakest. The supply tends to be very elastic. It's very easy for an occupier to build its own premises. So what I find more interesting is that the higher income return levels which is provided by such asset here, I've calculated the average for property in Europe. This is comparing 6% for offices to an 8% for logistics. So this provides you solid higher income return when it's brand new, well let. And one of the key things which I thought was interesting to see is that in most European markets, we saw a driver to be driven by online retail sales for occupier market. We have estimations of forecasts for online retailing to develop and to be quite growing with a very good, strong rate. And we do expect that there will be a sustainable demand driver in the next 5 years to come. So this is not about value growth. This is more about sustainable demand in the occupier market, which gives you a higher income return levels compared to other asset classes. The retail, finally, I've chosen the shopping center. This is the most liquid institutional market across Europe. This is also where we saw a quite impressive inward yield shift for the very best asset, particularly for the dominant schemes. We believe that retail is likely to be the most affected, particularly in terms of rent growth in the short term, due to the austerity, due to the weaker spending growth, which is expected. And actually, this is highlighted in the right-hand side of the chart, with expectations of consumer spending growth to be well below the historical levels achieved so far until the crisis. So all in all, what would be the drivers for capital value growth in the next 5 years? I think that the fundamentals in core Western European are still rent growth projections, which would drive the performance. In Western Europe, you can see, as highlighted below, in addition to the Nordics, there is a clear risk of upward yield shift in the next 5 years. The prime yields for core, the very best assets, have repriced significantly, with yields moving down quite impressively. But on the other hand, we see an opportunity for yields to fall in Southern European markets, where yields have remained quite high at historical levels. And there is a weight of capital now, because there are timing different, cycles of capital values different, that is currently reallocating to Southern Europe, which might drive some yield compression. All in all, in terms of IRR expectations, we do assume a 5-year hold period without taking into account the debt impact. And we expect for Western European core markets returns that are relatively low. So core, security has a price. We expect 5 to 6% IRR levels on a property level. And in Southern Europe, where the higher the risk is, greater returns will be. Southern European property market IRRs are expected to be between 8 and 9%. The most attractive long-term are expected to be where growth projections are the strongest, and it's outside the Eurozone in Central Eastern European market. The near-term outperforming sector is expected to be the office market. This is where we believe that occupier demand will recover first, from the business sentiment and also the employment growth perspective. Retail is slightly lagging behind because of this weak private demand expected over the next 2 years. To conclude, I think that this is showing you a pretty good picture of where the opportunities might be. What I did is taking each capital value market cycle, look at them in a wave relative to each other to see where the markets are in terms of repricing since the trough and projections over the next year, 2014. Those in green are actually the markets where we believe the trough has been passed and where we do see recovery trend. Those in blue are the markets where we should be at trough. And those in red and in orange are those where we still expect some further value falls over the next 12 months. So in red, you can find the French market. What it does mean, if you have followed all my development so far, and taking all the conclusions in terms of investment recommendations, I think that you want to remain core. 2014, I think that because of the weak growth prospect, because of the fragile recovery trend, investors are still looking for core and secured. So we believe that the prime yields will remain low, but this is to accept low returns levels. There is increasing appetite for riskier style in priced yielded locations, such as in the periphery, for instance, where we see the yield gap between the CBD and some of other peripheral markets. The yield gap is at historical highs. Then there is room for yield compression. We also believe that value add and also core plus in central locations where the supply risk is the most restrained, there will be opportunities to add value and to create value growth in the next 5 years. And we are seeing some reopening of the Spanish market. I think that we're still a bit early today, but next year will be definitely a turning point, particularly given the sentiment driving force which is surrounding the Spanish market. And actually, the yield compression can be much more faster than what we could anticipate, and particularly given the underlying occupier market fundamentals.